With November 5th quickly approaching, candidate signs are appearing in neighbors' yards, emotions are rising, and as a U.S. investor, you can't help but wonder, does any of this really matter for my portfolio? Today, we're going to tackle this and other questions at the intersection of markets and politics with Marta Norton, Chief Investment Strategist for Empower. Marta, great to see you. Thanks so much for being with us this afternoon.
Good to be here.
Let's just dive right into it. Let's get right to it, Marta. How much does politics matter to U.S. investors?
The headline? Less than you might think, at least as it comes to your portfolio. There's no question that historically speaking, the equity market volatility has picked up in the months preceding elections. But that's largely because investors hate uncertainty and elections are a source of uncertainty. In the wake of elections, we typically see markets stabilize. My favorite anecdote here comes from 2016, when strategist after strategist got in the media and said it was likely that markets would tank if Donald Trump won the election. However, we actually saw a rally in the markets in the wake of his victory. Between November 9th, 2016 and the end of the year, the S&P 500 returned about 4%. And more broadly, that's on trend. So since 1950, the average monthly return in both November and December during election years has been between 1% and 2%.
Fascinating. Love that perspective. And taking a look back as we start to take a look forward, that all makes sense, Marta, but it's not uncommon this time of year to hear this year is different. America's more polarized than ever. Based on what you know about this election cycle, is there anything that might cause greater volatility or even a market sell-off?
Well, there's no question that our emotions are running high during this election season, during this year. But the reality is I've heard that this is the most important presidential election of a lifetime since I was 18. So putting rhetoric aside, the events of the past few months have been really upsetting and very unusual. We've had 2 assassination attempts. We've had a change of candidates just 4 months prior to the election. If you had told me at the start of the year that we would have those events, I would expect some measure of volatility as a result. And yet the real volatility that we've seen in recent months has been far more related to the Fed, to the economy, to AI than it has been to politics.
So nothing to see here, no expectations for greater volatility as we inch closer to the election?
Well, listen, I'm not completely dismissive of the idea that politics or political developments could cause volatility. The most extreme scenario would be a market that is very complacent, bullish sentiment is very high, valuations are very stretched, and potentially there's an election that's contested and that drags on for weeks on end. But we have some corollaries to look at to see how the market would behave in those environments. So take 2000, when we had the Bush-Gore election, and that election was contested for several weeks. And it remained contested until December 12th, when the Supreme Court deemed Florida's recount unconstitutional. In the 1 month between election and December 12th, the S&P 500 lost 4%. We have a more recent example. We have in 2020, when the election was vocally contested, and on January 6th, Trump supporters marched on the Capitol. If we take a look at returns over that stretch, from November to the end of January 2021, we actually saw the market return 12%. So yes, political uncertainty can impact the market, but not in predictable ways.
So if politics aren't a big driver of markets, when does Washington start to impact the markets and impact our economy?
It's policy that matters. But remember, even here, it's hard to draw a straight line from one particular policy to how the market's going to behave, because we live in this dynamic, multi-variable world. So a pro-growth policy that generally benefits the economy can still hurt one particular area, or a policy that's more costly can still help certain industries. So there's a lot of uncertainty in how things actually play out. And that's one reason why I find studies that look at performance over presidential terms to be so misleading and misguided.
Let's talk about the current candidates. I know you're getting this question quite often recently, Marta. Yes. Anything that you would call out about our current candidates' policies that could impact markets, or how they might impact the markets?
Well, the devil's in the details, and we won't know the details or the devil until we see the congressional makeup. But I'd argue it's a mixed bag with both candidates. Take President Trump. He is pro-tariffs, increasingly so it seems, which tends to mean for higher prices for consumers. But he's also against regulation and for lower taxes, which can lower the cost of doing business. Vice President Harris, meanwhile, wants to see higher corporate and investment tax taxes and leads toward regulation, especially as it relates to the climate, those policies could mean a higher cost of doing business. But while the Biden administration has largely left the Trump administration tariffs in place, it's likely that she might not take as aggressive a stance on tariffs, which could mean that they wouldn't rise beyond current levels. Also, I'd point that there is some common ground exists, even in this partisan world, and that neither administration seems overly concerned about debt levels.
Well, at least that's one thing, right? Let's talk about the potential for unexpected election outcomes. You mentioned the Bush-Gore situation earlier. How should investors be preparing for potential surprises in this election cycle?
This might come across a bit boring, but it may be wise not to make changes based on an expected political outcome. For one, it's still uncertain. Current polls show that the election is quite close at the moment. The congressional makeup isn't understood or clear, and we're really at peak student government election moment, where the promises on the campaign trail have more to do with getting voters than they do with any sort of policy stance. So here's a simple strategy. Build your portfolio to meet your financial goal. Make volatility your friend, trim stuff that's running up, buy stuff that's selling off, and avoid the temptation to assume that financial markets are going to crash if the candidate that you don't like, or dare I say hate, wins the election.
Simple but powerful, Marta. Great insights. Loved our history lesson that we got as well. Thank you so much for being with us.
Yes.